China could shut down the Western world in about 6 to 9 months. I mean, shut it down. That's the end. Foreigners don't pay for tariffs placed on foreigners. Americans pay the tariff.
Fan favorite Steve Hanke returns to the show. He's a professor of applied economics at Johns Hopkins University. A couple of weeks ago, Professor Hanke was on the show, and he made the call that gold will go to $6,000. We're going to revisit that call because since September 21st, which was the air date of that particular interview, again, check it out, link down below, gold's gone up $700. We went from $3,600 around the time of the interview to now $4,300 today. We'll go over the math behind $6,000 and what Professor Hanke thinks is going on currently with the global economy. Welcome back to the show, Professor Hanke. Good to see you again.
Yeah, good to see you, David.
We'll also be talking about your book, Making Money Work. Some of the themes are very applicable to today's situation concerning monetary policy. And we'll go over some other economic items, including the tariffs, the new tariffs that Trump announced on China and what that's going to do to the economy. Let's start with gold. Since we spoke, like I mentioned in the introduction, gold is up $650-ish, which is not an inconsequential number. For gold, for any asset class, that percentage move in that short of time made troublesome people. Does it trouble you how fast it's moving?
Not really. I think, if I may,
sure.
Correlation does not imply causation, but
okay.
The minute after your podcast went up, the thing took off like a rocket. So at any rate, it happens sometimes. As I say, correlation doesn't imply any causation.
The people listening to you.
Yeah. So one thing we didn't really talk about when I made the $6,000 an ounce call is how you get there. And in simple terms, if you look at all the gold market secular bull peaks, going back to 1980, they always peak out when gold is around 10% of the value of disposable personal income per capita in the United States. So that's the back of the envelope thinking. And of course, everyone kept asking. They know I've been long gold. They know I'm a gold bull. And they keep asking, well, how high is it going? How high is it going? And I said on your show many times, I don't care how high it's going. If you're trading, the key thing is to know the direction of things. And the direction is up. And I'll worry about the peak later on. But finally, I decided I had to fess up and give you a number. So I gave you one, $6,000 an ounce. That's where it'll peak.
How does that correlate with monetary policy that you're expecting in the future? One theory I've heard, that may not be your own theory, but one theory I've heard is that the Fed is going to loosen monetary policy and we're going to have lower rates. We're going to have more money supply. That correlates with a higher gold price. All asset classes. That's exactly what happened in 2020. Are you making the assumption, based on your $6,000 forecast, that the Fed will inject more liquidity?
No, that calculation has nothing to do with foreign wars, monetary policy, the value of the dollar, anything else. It's just a calculation based on the behavior of past secular bull markets, where they end up. And they end up at around, as I say, a value of equal to 10% of personal disposable income per capita. So that's the calculation. Just a mechanical calculation. Remember when we talked the last time, you talked about a scenario that Goldman had put up where they had all kinds of things they were assuming, and if they assumed the war in the Middle East, the war in Ukraine, the Fed crashing, the dollar crashing, this, that, and the other thing, tariffs, if all that stuff happened at once, they said it would go to 5,000. But that's not the way I made my calculation. It's just looking at past behavior of the market and getting some handle on how high do these secular bulls go relative to income. That's the way to think about it, relative to the income that people have.
How high has it gone in historical measurements on a
Well,
percentage change basis?
again, it depends on where you start. I mean,
Yeah.
every one of these bulls starts at a lower level and then peaks out. But in the meantime, starting at the bull and ending at the peak, the disposable income per capita was a lot lower then. So the price is a lot lower. But the percentage is 10%.
This is an article from the World Gold Council that may support your point, Professor. Gold opens as $4,000 per ounce chapter. Gold is only 735 days. This was written, when was this written? This was written a couple of days ago, the 13th of October. But it says gold has only 735 days into this rally. Previous major rallies have lasted, on average, 1,062 days. But again, the previous rallies have not moved up this much in such a short amount of time. The magnitude is a little bit different. This time is different, as they say. I mean, it is different. To understand to make the prediction of what's going to happen in the future, I think it's important to understand what's happening currently. Can you help us understand why there's such a frenzy right now with the gold market?
Well, I think in general, there's a tremendous amount of uncertainty that really isn't being priced into the equity markets or other markets at all. But they remember, gold is something that deals with a so-called tail risk, where it kind of sucks in the uncertainty bet. Let's put it that way.
Yeah.
So if there's a lot of uncertainty, you got these foreign wars going on. You've got very weak leadership in Europe. By the way, Europe is a huge place, and we have, I think the Three Stooges and the Prime Minister of Great Britain, Starmer, is one of the Three Stooges. Very unpopular, by the way, extremely unpopular. And then you've got President Macron in France. He's another he's a second of the Three Stooges. And France has just overturned its government. I can't keep track how fast they're turning over the governments in France under the presidency of Macron. And they have huge fiscal problems, by the way. And then number three, the third stooge, is Merz, the Chancellor of Germany. And Germany's just got so many problems. They cut themselves off and turned a blind eye to this blow up of Nord Stream 2 and cutting the Russians' gas supply down. And so cheap gas from Russia is dwindled down to a very small percentage of the total, and they're planning on cutting it completely off. So what is substituting for that gas, the Russian gas, is liquefied natural gas, mainly from the United States, but the cost is about 3 times higher than the Russian gas. So they're paying an arm and a leg for this substitute, LNG. And it almost looks like the U.S. blew this thing up on purpose, because it expanded the market for U.S. LNG. I mean, basically, remember that famous quote with President Biden? He basically said they were going to blow it up. And it's very clear, if you look at Seymour Hersh's investigating reporting, that the CIA knew all about this blow up before it happened. Probably the German chancellor knew about it before it blew up too. But at any rate, they're paying a lot more for liquefied natural gas than cheap Russian gas. And then there's another catch in the thing that people aren't aware of, and that is the Russian contracts are take or pay contracts. So if they don't take the gas from Russia, they have to pay. So they're paying on top of it. They're paying Russia for the gas that they're not even using with these take or pay contracts. So you've got a huge increase in energy prices in Germany that are really forcing Germany to deindustrialize its whole economy. Of course, that's what the Americans, by the way, after World War II, the Secretary of Treasury, Morgenthau, That's what he wanted. He wanted a Germany that was kind of a little agrarian, a bunch of peasants running around with no industry or anything like that. That was the idea. That was the U.S. post World War II idea. It didn't happen. The Marshall Plan came in, and Germany industrialized, and the manufacturing sector in Germany is basically, in a proportion to GDP, about twice as big as most of the manufacturing sectors in the European countries. It's about 23% of GDP. And then you look at France, for example, France is about 12 or 13%. But Germany's shrinking. And if you look at the World Economic Outlook, IMF report of this week, came out on the 14th, you essentially have no growth happening in Europe. Germany, they're forecasting at 0.3% this year, and 0.7% for France, a little below 1% in the UK. The Europeans are just on their back. So that fits into the gold picture, by the way. And you've got the US, I think, which will go into big slowdown, if not a recession. And gold always does well before hard economic times. Once you get economic slowdowns, times get hard. People don't pay their debts. They all kinds of problems start popping up, and gold does well, by the way. So you have a number of things going on that are very uncertain right now. The environment's very uncertain. It's not showing up in the equity markets or bond markets or anything like that. But what catches it, what's like a magnet for people who are worried about uncertainty, is gold.
Gold and silver have reached historic highs, and amidst this crazy bull rally, more investors are turning to hard assets to protect their savings. But what if, instead of just holding your gold as a savings vehicle, you could actually earn income from it paid in gold? So now it's not just in savings, it's also an income vehicle. That's what today's sponsor, Monetary Metals, helps you do. They're changing the way people think about investing in precious metals completely. Rather than letting your gold sit idly or paying fees to store it, now you can get paid to own it. Right now, through their marketplace, you can earn up to 4% yield on gold, paid monthly in gold. Your savings grow in ounces, not dollars, and stack on top of any price appreciation. Thousands of investors are already earning real yield in physical gold and silver through Monetary Metals. It's time to see how it works for you. Go to monetary-metals.com/Lin, link down below, or scan the QR code here to learn more. Why should it show up? In what sense should it show up in the equity markets, Professor? What do you mean? What did you mean by that?
I think the equity market in the United States, let's talk about the United States, is in a bubble. And that bubble, that means the market's overhyped, overpriced, overvalued. There definitely is a bubble in the equity market in the United States. Everyone is just ignoring all of the uncertainty, all of these potential problems. The equity market just keeps slow walking into, I think, what's going to be a deflating bubble. Now, whether that bubble pops or whether the air comes out slowly is another issue. I don't know. No one knows when these bubbles, how they adjust, how the markets adjust to more realistic valuations. But it will adjust, and the air will come out of it, either with a pop very fast or slowly seeping out. And we don't know when that's going to start. So all of that, the only thing I know for certain, it's in a bubble. I know that, but I don't know the rest of the story, and no one else does either.
I had a conversation with another trader just before you, and he was musing, what is a bubble? How do you even define a bubble? How do we know we're in a bubble when we see it?
Read my bubble detector articles in the National Review, Forbes magazine. I think even Fortune I have.
Oh, okay.
It's easy to calculate.
So let's say I gave him this example. Let's say a company is making $10 a year. but its enterprise value is at $1 million. Well, we could safely assume that it's in a bubble. That doesn't make any sense. And then he says, well, what if it's only 900,000? What if it's only 1,000? You know, at what point does a valuation disparity become a bubble, right?
Well, you again, you have to relate it like the gold thing. If you look at Dr. X's bubble detector, which is my bubble detector, and the reason it's Dr. X is that a Nobel laureate in economics who didn't have time to finish the thing gave it to me, and I as a courtesy, I'm not going to name who it is because he wasn't there when I finished it.
Yeah.
So I can't say who it is, but the origin was a Nobel laureate in economics who handed the thing off to me. I finished it and have dealt with it. It's a very good indicator of when the market's in a bubble, and it's related to the value of things relative to income, and that relative to income means what? Intuitively, how long it takes you to buy an asset, or how long it takes you to buy yield. And then you look at the yield, how long it takes you in the bond market, and how long it takes you in the stock market. And the thing is very imbalanced now. It takes you a lot longer to purchase a given amount of yield in the stock market than the bond market. I mean, that's the intuition behind it. But go to Hanke's articles on Dr. X's bubble detector, and all these people spin these yarns and hypotheticals, and the thing you started going through, this nonsensical BS, basically. It's all related to income, and it's all related to how long does it take you to buy yield, and if it takes you an excessively amount of time to buy yield, you can bet your bottom dollar you're in a bubble. And how do you know it's excessive? Well, you have two huge markets. One's a bond market, and the other is a stock market. And if it's taking you an inordinate amount of time to buy yield in the stock market relative to the bond market, you got a bubble in the stock market.
Do you think people are buying stocks despite really high valuations in the same fashion or for the same reason that they're buying gold, perhaps? That they see all this uncertainty in the world, they don't want to park their money in fiat dollars for fear of losing value to inflation or anything else, and so they're buying just anything they can get their hands on. People may not have enough money to buy an ounce of gold or a house, they buy stocks. Does that theory make sense to you?
No.
Okay, fair enough. So stocks represent risk, is what you're saying.
I can tell you've been influenced by the people you've been interviewing.
I've been very lucky to be influenced by yourself in some capacity. But that is,
at least put Hanke in there as a footnote.
I quote Hanke's golden rule quite often on monetary policy, which we'll talk about later today. Okay, so stocks are in a bubble. Gold currently not yet in the bubble. It's going to take another 60%, by the way, of gold rally to climb to $6,000.
By the way, I'm not saying that there won't be corrections along the way.
I understand. What about silver, by the way? We need to talk about silver. $54. I'm pretty sure my viewers would like you to attempt to do the same calculation with silver that you've done for gold. This is the historic price of silver going all the way back to the 1800s. But anyway, you can see that it's only happened 3 times in history that it's breached $50. And now for the first time in history, it's sustained above 50 and now gone to 54.
Well, we got to go back to 1980 and the Hunt brothers corner of the silver market to get up that high. Now, one of my friends, which I grew up with in Iowa, rural Iowa, called me the other day. I'll leave him anonymous. He doesn't probably want his name known.
Sure.
He is a public figure, by the way. That's another reason that I don't want to name him. But he's an old pal of mine, and so he called me and he said, Steve, he says, silver's made a new high. That's when was 51. It went up to 51. He called me, and he says, well, what do you think? Should I sell my silver? And I said, well, what do you got? You got contracts? And he says, oh no. He says, I've got bullion. And then he sent me some photographs. He does have bullion as well as silver coins on it. And I said, I think I just relaxed for a little while. I said, let it run a little longer. Let me think about this. What one would do. And I haven't responded to him yet. Actually, I called him this afternoon and couldn't get a hold of him. We were going to brainstorm what to do because he's got a hoard of silver. I mean, a lot. You know, he's got enough. Yeah. Put it this way: if you put it in the trunk of the car, the damn car would go to the pavement probably.
If he were a fund, he'd probably have a mandate to only own a certain percentage of his portfolio in one asset. Now that asset, in this case, silver, has ballooned in weight, quite literally. We could probably assume the fund will want to rotate out into something else. But I don't know if that logic applies to the regular person. When something's gone up, 100% in a year, normally, if it's anything else, one would want to take profits 71%.
Well, he was scratching his head because he said under the presidency, he prefaced the whole thing with the following. He said, well, under the economic policies of Joe Biden, he thought silver would take off, and it never really did much of anything. And he says, now it's taken off. You think I should sell? That's how the conversation started. I think this rebalancing of portfolios is actually important. Maybe not so much in commodities, are kind of a separate category. But let's take the simplest thing, the standard plain vanilla stock bond portfolio, 60-40.
Yes.
And I think we've talked about this before. I think people, they asked me, well, Hanke, should I be taking money out of the stock market? And I say, not necessarily. And they say, well, what do you mean? You just said it was a bubble. And I said, yeah, I know. I told you it was a bubble, and I told you I didn't know when the bubble was either going to pop or seep air out of the thing and adjust. So I can't predict that. So they say, well, what do you do then? You're so smart. Tell me what I should be doing. And I say, look, you had it 10 years ago or 5 years ago or whatever starting point you want. You had a balanced portfolio. It was 60-40. And I can guarantee you it is no longer 60-40. It's probably 85-15. So I would rebalance on that basis. You see what I mean?
Yeah.
I think a lot of people are probably, and especially I'm talking about older people. Let's say people over 50 or 55, something like that. I bet all their portfolios are imbalanced now, overweighted in stock. Mm. Just because of the big run in the stock market. So in that case, I would think about, well, do I want to go back to my plain vanilla ratio, whatever it is, 60-40 or 70-30 or whatever it happened to be? Do I want to adjust or not adjust? And I would say it's probably prudent to adjust.
Adjust into what is the question? What would seem relatively more undervalued now? If
you have a portfolio with and you're dealing with two asset classes, stocks and bonds, you lighten up on stocks and put more into bonds. It depends on the mix of your portfolio. So there are other people who would have stocks, bonds, and gold, for example.
True. All right, we have to talk about Trump's policies. Speaking of the current administration, as you're aware, Trump announced a 100% tariff on China last Friday. He likes to make these announcements after market close. But then he, over the last weekend, also made posts on social media saying that the great respected Xi Jinping and himself are currently going to talk it out. China has said that they're not going to back down from this new 100% tariff. And since Trump has made that tweet or post on Truth Social over the weekend, markets have rebounded somewhat on Monday, especially. My question to you is whether or not this is actually going to go through. Apparently, it's going to take effect on November 1st, which is coming up in exactly 2 weeks. And a lot depends on what the Chinese do, said U.S. Trade Representative Jameson Greer. I wonder if this is just theater before the 1st of November, or will we actually see an additional 100% tariff slapped on China come the 1st? What do you think?
It's a little bit hard to say. Let's walk through this, because the front page of the Financial Times of London yesterday had a huge headline. Secretary of Treasury Bessent was going after China and Chairman Xi for starting a trade war. So this spin is so ridiculous. I mean, the U.S. started the trade war, not China. China's just counterattacking now by putting restrictions and bans on the export of certain critical materials, certain rare earths, and the technology that can be used to process these, because China controls these things. And people do not realize that, and I think Trump might realize this and come around after threatening. China could shut down the Western world in about 6 to 9 months. I mean, shut it down. That's the end, baby. Of course, by cutting off all these critical materials. So
True.
think about it. If you're facing the chairman of China, and you know he can pull a trigger and blow your head off, are you going to stay in the fight? Are you going to commit suicide?
I would get out of the way and find another way to get the critical minerals.
Yeah, and that's going to take you about 20 years. Think about that.
Well, this is what Scott Bessent is trying to do to counter that. So first of all, he's made a series of remarks. You're right. He's saying that they started at he's also saying that the entire world is going to decouple from China. I don't know. He's starting to speak on behalf of the entire world now, Mr. Scott Bessent. He's saying the entire world is going to decouple from China. Is that true? The entire world is going to decouple from China? China is going to act as a lone actor? And
well, he's starting to echo the president of the United States, Donald Trump. I mean, Trump thinks he speaks for the world too, and Bessent is saying the same thing. The Bessent's statement was just absurd. I mean, it's factually incorrect, by the way. But in the West, they spin, and the press spins, and people believe the spin. The public is not. The public really are not the sharpest knives in the drawer.
Well, this came in yesterday. Bessent wants to put price floors. We're going to set price floors in the forward buying to make sure that this doesn't happen again. We're going to do it across a range of industries. This is in response to this statement. China has driven foreign competitors in the rare earth industry out of business over the past 2 decades. What happens when the government sets price floors, Professor?
It's a disaster. It's like either a price ceiling or price floor. It's price controls. This is interventionism. This is basically, these guys are, in a way, they're copying China's economic model. This is an interventionist model, and it used to be called socialism. So we've had in the United States a lot of this going on, but now it's really, Biden was in it. That was a model, the interventionist model, with the government meddling and everything going on. Now with Trump, it's on steroids, and it's transparent. We know it, but people are, as I say, not the sharpest knives in the drawer, and they don't think through what all this means. What all this means, you've got a bunch of politicians in Washington that have their hands on the controls of of not only the economy in general, that's fiscal policy, monetary policy, that kind of macroeconomic stuff. They are actually saying to certain businesses, we don't like the CEO, fire the guy, get rid of him. They're telling people in various sectors of the economy who to hire and who to fire. So this is unbelievable that what's going on. I think the term socialism has morphed into interventionism. That's what we as Austrian economists, Ludwig von Mises, Friedrich von Hayek, it's called interventionism. Or we can also label it things that people understand. It's politicizing all aspects of life. You can't do anything in business anymore without being looking over your shoulder what Uncle Sam is going to be doing.
Bessent said, when you are facing a non-market economy like China, then you have to exercise industrial policy. He's not calling this socialism or interventionism. He's calling it industrial policy.
This is the stupidest statement. He's basically saying, read the first sentence, and I'll read the first sentence again.
When you are facing a non-market economy like China, then you have to exercise industrial policy. He said.
He says then you have to become a non-market economy yourself.
Okay.
That's what he's saying basically. And by the way, if you look at what's going on in the United States, they always say, well, China's copying the United States. China's stealing intellectual capital and technology and that kind of stuff. Well, we're copying the Chinese economic model. We're copying them. They're not copying us. The Chinese should be raising Cain because we're copying them.
The notion that you're going to set a price floor, how is that different from a bailout? If you're going to set a price floor, isn't that just bailing out an industry?
Of course.
So they could just give them money and
they are giving them money too. They have all kinds of things that they're doing, but it doesn't. These things in mining, metallurgy, and material science, these things don't happen overnight. It takes a long time. It takes a long time to develop a mine, for example. First, you've got to find the stuff. And they assume all you do is get a good geologist and drive around in the countryside in Montana or Wyoming, and you find this stuff, all over the place. It doesn't happen that way. And once you find it, then you've got to develop it. But to develop it, you've got to get 1,000 permits, not only federal permits, but state and local permits to do it. And all this stuff is wrapped up in all kinds of idiotic regulations that the U.S. has put in over time. And the reason for that, by the way, there is a big difference between China and the United States. Now, in China, the lower level politicians are, again, not the sharpest knives in the drawer, totally corrupt, and all they do is spend their time drinking tea and smoking cigarettes, and moving a lot of money, back cheese around. You got to bribe them to do this, that, and the other thing. That's at the low level. But at the top level, it's heavily weighted with highly trained engineers. The top of the hierarchy are highly trained engineers. Now, in the U.S., the bottom is the same. You got a bunch of dull knives. But at the top, you got a problem, because if you go to Washington, D.C., what are the professions of the politicians? They're all lawyers. Why do you think we have so many regulations and red tape? Because that's what lawyers are trained to do.
Could engineers make laws? Now that's another question for another time.
At any rate, if you look at what's going on in China, it's really rather remarkable. They're advancing, whether it's AI or any what I call the 3 M's: mining, metallurgy, and material science. They're so far ahead of the United States and moving out faster, and it's because It's because they place a lot of emphasis on advancement with regard to merit.
Another reason I brought up China is I want to ask you whether or not the 100% tariff, should it go through, will have a significant impact on inflation. Take a look at my screen here. This is the headline CPI rate. As you know, the last number from August was 2.9%. That's a big increase from 2.3 earlier in the year. This is the Hanke's golden growth rate of 6% is not yet reached. The money supply is not yet growing at 6%. And so help us understand whether or not this temporary rise from 2.3% earlier in the year to 2.9% is transitional, or as Jerome Powell would call it, transitory.
Yeah. Okay. Well, let's not get back into the transitory thing.
Okay, fine.
Remember, we had that with COVID. The thing to remember is that inflation is always and everywhere a monetary phenomenon. So basically, these aggregate price indices, whether it's a CPI or PPI or what many indices, they are geared and move with a lag after things have changed in the money supply. And I think I've mentioned before, I've looked all over the world at all the significant inflations. Now hold on to your hat. I know you don't have a hat on. Maybe you've got one next to you. You can hold on to that. But 4% is a significant inflation. In Hanke's book of rules, 4% lasting 2 years or more, that qualifies as a significant inflation in Hanke's book. And we have never seen a significant inflation any place in the world unless there wasn't a prior significant increase in the money supply. Never. So back to your question, David, I'm rather relaxed about where the inflation is going, because we've had since April of 2022, the money supply was contracting, stock of money was going down, and it bottomed out in the summer, this past summer, and now it's come up a little bit. So the stock of money is not much higher than it was back in the beginning of 2022. So I'm not, and as you said, the golden growth rate for the money supply measured by M2 and consistent with hitting an inflation target of 2% is about 6%, just a tad over 6%. Let's just call it 6. And it's growing a little bit under 6 now. So I'm not in the camp that says the tariffs are going to be the end of the world with inflation. Tariffs will impose a sales tax on Americans for goods that they're importing. There's no question about it. Now, those imported goods will go up in price relative to everything else. And the only way the everything else could be coming up is if the money supply would be going up and the money in the hands of the non-bank public would be increasing to allow them to be spending more. If they're spending more on the imports, David, they have less income to spend on other things.
I think that's what people mean by we're experiencing a lot of inflation, because a lot of the things that you're talking about, like the imports being affected, those are the things that that the regular person is consuming more of. Think about everything we're using in our everyday lives is coming from China and other places. So
this is exactly the point. You've nailed it. Now, when people think about inflation, remember eggs. Remember when the egg inflation occurred? We had the avian flu and so forth. This is within the last year. Eggs are still pretty damn expensive, by the way, but they were a lot higher. So people would go to the grocery store and they'd say, "Oh, the egg price! Oh my word! Whoa, man, we've really got inflation." I just went and bought eggs. I mean, So somebody would go to the store, and what would they do? They'd walk out of the grocery store with sticker shock, saying, "Gee, I used to be, every time I'd go to the grocery store, I'd be spending $200. The bill was $250 this time. We've got huge inflation." Well, yeah, groceries were going up relative to everything else. They weren't telling you that, oh, computer prices were actually going down. iPhones were actually going down.
Right.
So
Right.
So the perception is that inflation is still a big problem, and part of that is that imported goods are definitely going up. By the way, the imports, I can't remember the exact metric and measurement, but it was like imports were going up at a 4% per annum rate, and all the regular stuff was going up like 2%. I can't remember the exact metric, but it was import prices are in short going up about twice as fast as other goods and services. And that doesn't surprise me, because the imports, the Americans that pay a sales tax on that, forget the spin and propaganda coming out of Washington. Foreigners don't pay for tariffs placed on foreigners. Americans pay the tariff. When the import comes into the customs office in the United States, the tariff is paid in the United States at the tariff office by Americans.
Well, I like to close off on two things. First, what the Fed's going to do in response. Right now, the bond market's still pricing in one cut in late October and then another cut in December. But suppose we have import prices go all the way up, then the Fed may need to reconsider. I'm thinking, I don't know, what's your take on how the Fed will react to?
My take is exactly on what you have with those charts. The only objective measure we have for what the Fed's going to do with federal funds is to go to the Chicago Mercantile Exchange and look at those charts that you just put up there. What was the percentage for the October meeting and the December? What were they?
Both pretty high. October is 97% of a cut, 25 basis point cut. And December is basically 100%, 83% chance of one cut. A 25 basis point cut, and then a 16.7% chance of a 50 basis point cut.
Okay, now you asked me a question related to those. You say, well, what's my take on it? Well, my take is the market's take. My take is exactly what you just gave. And that's what people should pay attention to. They should pay attention to market prices. Market prices are objective. They're the accumulation of all the subjective, all the know-it-alls, everybody who has an idea about where the Fed funds rates are going to be going, and they have money they want to put on the line, get skin in the game. All of those people, supply and demand, they come in, and the market determines the price. And that price is my price.
I want to finish off on this news, Professor. We have a few minutes left. Regional banks are showing signs of cracking. You remember how you mentioned earlier that there's a valuation bubble in the stock market? Well, here's one sector that's showing some cracks right now. Shares of regional banks and investment bank Jefferies tumbled on Thursday. Zions Bank Corporation dropped more than 13% midday. Western Alliance Bancorp fell more than 10%. The index that tracks this, the SBDR Regional Banking ETF KRE, lost around 6% in one day. Latest signs of trouble came when Zion said Wednesday evening it faced a sizable charge because of bad loans to a couple of borrowers. The bankruptcies of two auto industry related companies this year have raised concerns about loose lending practices. Sounds like their lending practices are coming to surface in the news, Professor. We have to follow this story. It's a developing story. What's your immediate reaction to what I just read?
Well, my immediate reaction, this doesn't surprise me, because we've been seeing the delinquency on mortgages and loans and things going up for some time, by the way. This has been going on for a long time. Now it comes to specific banks who are fessing up because they have to give guidance and issue their financial reports, and it becomes accentuated. Let's say we've known this in aggregate. You can go back and You can pull up a chart for delinquencies, and I'm certain you see the thing going up, 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 and no one pays any attention. This is how we started our interview. No one is paying any attention to any of these uncertainties in the market until you get a pinprick, and the pinprick. But see the design. See that? See the delinquencies?
It's gone up, but the critics of what you're saying would say, well, it's still lower than the historical average, even though it's shot up.
Well, it is, and that's why they haven't paid any attention to it. But we have two banks that are talking about being forced to reserve more because they've been hit, and they issue guidance, and they have to talk about their financials, and then people focus on it. This general thing that you've just given me, that's exactly what that goes in the press, and the press writes delinquencies are going up, but they're still pretty low. Nothing to worry about. That's fine. But now we've had some specific cases that are specific to particular banks, and there's nothing more important than the balance sheet. So if they're writing off this stuff, people pay attention to it, and the valuations adjust.
Okay.
You notice all the banks didn't adjust.
No, that's right.
I think Jeffries and Zion did drag everybody down today. I'm sure they're all down a little bit, not as much as Jeffries and Zion, but.
Well, there was a bit of a market sell-off overall today, but okay. So we'll keep tabs on what's happening, Professor. Good talk today. Let's close it here. Where can we follow you before we go? Where can we follow you in the meantime?
You can follow me on X at Steve_Hanke. That's the best way in real time. And I'm just looking now, David. I'm at 808,500 followers. So
wow,
I'm rated as the third most influential economist in the world on Twitter by Focus Economics in Barcelona. I mean, it's not me saying this. Focus Economics says it. They rate everybody.
Mm-hmm. Okay, well, let's get you up to number 2 soon. So do subscribe and follow Professor Hanke in the link down below to go to his X account. Do subscribe to this channel if you haven't already to follow regular content and see Professor Hanke's next interview with me. You can always submit questions on the channel itself, comment down below, or write to Professor Hanke. We can put his email down below. I would like to see, we haven't talked about this, we can save this for next time. I would like to see next time your hyperinflation tracker. I wonder who's hyperinflating and who's not today.
Okay, the two highest, by the way, are, number one is they're not hyperinflating. Venezuela is inflating very rapidly, and also a new one, by the way, that I'm watching closely. North Korea.
Don't tell us. Let's save it for next time so people can tune in.
Oh, we'll get into the weeds next time. The only thing would say about following me on X, since I'm a free market, voluntary behavior kind of guy, I can't mandate anything. I can't even mandate my students to do things. But if I could, I would mandate you to follow me on Twitter.
All right. You heard it. You heard it there. It's been mandated. You click that follow button. Yeah.
Now, as they used to say at the end of Paul Harvey's radio programs, now you know the rest of the story.
Okay. Yeah. Don't want to disobey the mandate. Bad things will happen. Thank you, Professor. We'll speak again soon.
Yeah.
All right. And thank you for watching.
Thank you.